Joining us now is Bill Smead. He's the Chief Investment Officer at Smead Capital Management. Bill, it's great to see you again. Welcome.
Hey, great to be with you.
Jump in here. You can pick the housing piece first if there's anything in that last discussion that, you wanted to chime in on.
Well, I don't want to pick on your prior guests too much, but somebody once said if you put all the economists end to end, you'd never get anywhere.
Understood. So do you come down as in this is an economy that can be strong with productivity and low inflation, or no? That's what the president wants, or things can happen.
The most productive multiplier effect in all of economics in the United States economy is home building and household formation. So in my opinion, it's more important how soon Taylor Swift has a baby is more important to the economy than what the Fed does. All this Fed stuff, right? So think about it. The president has suppressed gasoline prices to give people the feeling when they go to the gas pump that they're getting a deal, while the Strategic Petroleum Reserve is empty. If we ever actually had to fight somebody, we'd have no oil in the tank. And then hope you ignore the fact that when you go to your favorite restaurant, you're paying 30% more than 2 years ago.
Right. Even if Taylor has a baby, Bill, is that going to help people start families, afford housing, give the economy the kind of kickstart you're envisioning?
Well, you get out of an apartment when you have a baby. When the baby's crying, you don't want your next door neighbor banging on the wall and saying, "Gee, can you get him to be quiet?" And the answer is no. You're not supposed to get a baby to be quiet. So the situation is that the Trump administration has been brilliant in pulling all these levers and attempting to make all these relatively violent short-term disruptions. But the most important thing to the economy is too much money chasing too few goods. And one of your economists made a great point, and I see this in my neighborhood. There are $10 million homes being built in Phoenix, like hotcakes, but yet the mortgage rates are too high to convince someone that has a 3 or 4% mortgage to trade up to another home,
which is more than half of primary mortgage holders. The Journal had this stat this week. They said 54% of people have a mortgage at 3 or 4%, I think it was. So what would you envision? I mean, are these policy changes going to be able to rectify this whole situation, or no?
No, we have a kind of a strange theory, and it has to do with why does Willie Sutton rob banks?
That's where the money is.
And that's where the money is. So if the Fed or anybody else wants to get long-term interest rates down, money has got to go from where it is, which is in the 8 largest cap stocks in the S&P 500 index, to something that would to buy bonds. That's where the money is. And it's not in long bonds. So they cut the short rates and the long rate goes up. The only way you're going to get long rates down is break the mania for the S&P 500 passive index.
Right.
That's
the
only
S&P
way you're going to get long rates
higher. Down. Right. Well, if you hold bonds, you're kind of unch. I mean, you're doing okay. You're not doing great. So people would have to think, I'm going to make a lot of money, or the alternatives are not going to look that great. And I don't think the president's interested in either one of those outcomes.
No, that's right. You're absolutely right. So the answer is, from a historical perspective, stocks have been fantastic for really 15 years off and on, with only relatively short bear market interruptions. And when people get afraid of stocks, that is when long-term rates will go down. People seek safety. And the equity risk premium it is completely out of line, and so are. Somebody mentioned yesterday or the day before that an ounce of silver is worth more than a barrel of oil.
Correct.
And I think that's only happened once or twice in the last 40 years or something.